Hello everyone, Iggy here from the Investing Iguana. It's great to have you with me. If you are a Singaporean investor, and especially if you're a unit holder in Mapletree Industrial Trust, you probably saw the latest Q2 results and felt that familiar knot in your stomach. The headlines were not kind. They screamed a 5.6% year-on-year drop in the distribution per unit, the DPU. And in an environment where we are all hunting for stable income, seeing one of the blue-chip industrial REITs post a drop like that, well, it's unsettling. But here's why we do what we do at the Investing Iguana. We cut through the noise. We look past the scary headlines to find the real story. And the real story here is much, much more complex. Because if you strip away a one-off divestment gain from last year's numbers, the actual like-for-like operational decline is just 2.2%. Now, 5.6% looks like a problem. 2.2% looks like a challenging quarter. See the difference? I'm Iggy, your Singapore-based market analyst, and my entire mission is to break down these dense, complex SGX earnings reports and show you what really matters for your CPF and SRS portfolios. Today, we are going to do a deep dive, slide by slide, through MIT's second quarter and first half FY25-26 financial results. We will break down every metric from MPI to aggregate leverage. We will decode what's driving the changes, both the good and the bad. And by the end, we will figure out together whether this industrial and data center giant still deserves a spot in your income portfolio at its current price. This is the kind of deep dive analysis I do every week for my subscribers on Substack. So let's get into it. All right, let's pull up the first slide. Slide 1. Cover an important notice. This is the standard disclaimer page. Every company has one. Past performance doesn't predict future returns. Units can fluctuate. Forward-looking statements carry risk. It's very easy to skip this, but I want to pause here for a moment. For us, as Singapore REIT investors, this notice is a crucial frame. It reminds us that REITs trade daily on the SGX. You can't just call up the manager and redeem your units like in a unit trust. Your exit is through the market, which means liquidity and price are set by daily trading. More importantly, look at the description. Focused on industrial properties in Singapore and data centers globally. This is not your father's Mapletree Industrial Trust. It's not just a collection of flatted factories in Kallang anymore. This REIT has transformed. Its focus on data centers means it is now exposed to global tech sector demand, to US interest rates, to currency fluctuations, and to global economic shifts. This has changed the risk profile, and it's why we have to look so closely at the numbers. Okay, let's get to the meat. Slide 2. Key highlights. This is the most important slide in the whole deck. It's the entire story in a nutshell. Let's break it down. First, net property income, or NPI. This is the core engine of any REIT. It's the gross rent minus the property level operating expenses. MIT's NPI fell by 7.8% year on year to $124 million. This drop was driven by three main factors. First, the divestment of 3 Singapore industrial properties in August. They sold these assets, so the income from them is gone. This was a strategic choice. Second, the North American portfolio. It saw lower contributions due to lease non-renewals. This is an operational headwind. And third, a weaker US dollar. Remember, nearly half of MIT's assets are in North America. When they collect rent in US dollars, it translates back to fewer Singapore dollars when the USD is weak. This is a macroeconomic headwind. So NPI is down 7.8%. But look at the next line. Distribution to unit holders. That's only down 5.3%. Why is this drop smaller than the NPI drop? The answer, which we'll see later, is that their borrowing costs came down significantly, cushioning the blow. Now, the number everyone is talking about. DPU, distribution per unit. At 3.18 cents, it's down 5.6% from 3.37 cents a year ago. This is the headline. But right here, management gives us the critical context. Last year's 3.37 cents included a one-off divestment gain from the Tanglin Halt cluster. That was a windfall. It was never going to repeat. If you exclude that gain, last year's recurring DPU was 3.25 cents. So, the like-for-like, apples-to-apples comparison is a drop from 3.25 cents to 3.19 cents. That is a decline of just 2.2%. Let's be very clear. A drop is still a drop, but a 2.2% drop from operational headwinds is a manageable challenge. A 5.6% drop looks like a 5-alarm fire. The 2.2% is the relevant figure for anyone who bought this REIT expecting sustainable recurring income. Now, let's look at the good news on this slide. Tucked away under capital management, MIT's aggregate leverage ratio decreased to 37.3%. It was 40.1% just a quarter ago. This is a massive improvement. How did they do it? They completed that $535.3 million divestment of the 3 Singapore properties and used the cash to pay down debt. For a Singapore REIT investor, this is exactly what you want to see. The MAS regulatory limit is 50%. At 37.3%, MIT has a fortress balance sheet and a massive amount of debt headroom. This is prudent, active capital recycling. They are selling mature, lower-yielding assets and using the cash to strengthen the company. This is A-plus management. Let's move to slide 3, the 2Q and 1H financial performance. This slide dives deep into the income statement. We see gross revenue down 6.2% and NPI down 7.8%. For all the reasons we just discussed. But I want you to look at one line. It is the bright spot of this entire quarter. Borrowing costs. They fell 20.0% year on year from 27.1 million down to 21.7 million, 20%. In a high interest rate world, how is this possible? 3 reasons. First, the big one, debt repayment. They use those divestment proceeds to pay down their loans. Less debt means less interest to pay. Second, lower interest on their floating rate loans. Our local Singapore interest rate, SORA, has actually eased from its peak levels in 2024. Third, favorable foreign exchange effects on their USD denominated loans. This 20% decline in interest costs is what saved the DPU. It acted as a powerful cushion that partially offset the 7.8% drop in NPI. This is the key tailwind that is helping most S-REITs here in 2025. If we look at the half-year numbers, it's the same story. DPU was down 5.1%, but excluding that one-off gain, the decline was just 1.8%. This tells me the core operations are remarkably stable, even with the headwinds. Slide 4 is the quarter-on-quarter performance. Honestly, I'm going to tell you to mostly ignore this. The DPU dropped 2.8% from Q1 to Q2, but this is just noise. It's driven by the timing of the divestment, which was completed in mid-August. This means they had a full quarter of revenue from those properties in Q1, but only 1.5 months of revenue in Q2. For a long-term income investor, quarter-on-quarter volatility is normal, especially around asset sales. Always focus on the year-on-year comparison. That's what shows you the real trend. Now let's look at slide 5, the statement of financial position. This is the balance sheet. As of September 30th, 2025, total assets are down 7.7%. This is not a surprise. They sold $535 million worth of assets. But look at the other side. Total liabilities are down a massive 16.5%. This is that debt repayment at work. This is active management strengthening the company's foundation. Net asset value, or NAV, per unit dipped slightly by 1.2% to 169s. Now, as of late October 2025, MIT is trading around $2.22. At a NAV of $1.69, that gives it a price-to-book ratio of about 1.31x. Is that expensive or cheap? Well, the average S-REIT trades at about 0.9x book. So 1.3x is definitely a premium. It's not a screaming bargain. Why is the market paying this premium? One word, data centers. The market believes in the long-term growth story from AI and cloud infrastructure, and it's willing to pay up for MIT's 58% exposure to that sector. Slide 6 just hammers home the balance sheet strength. We already know leverage dropped to 37.3%. The interest coverage ratio, or ICR, is 3.9 times. This is very healthy. It means their earnings can cover the interest payments almost 4 times over. The danger zone is 2.5x, so they're nowhere near it. And their interest rate hedge ratio is up to 92.9%. This means 93% of the debt is fixed or hedged, protecting them from rate volatility. But here is the trade-off. This is the next headwind we need to watch. Management warned in the results that approximately $600 million of interest rate hedges will expire this financial year, and another $600 million will expire next year. The new hedges they put on will be at today's market rates, which are higher than the old rates from 2021. So that 20% drop in borrowing costs we just celebrated, it's temporary, That number is going to start climbing up in the coming quarters as they replace these old, cheap hedges. This is a sector-wide issue, and it's a key headwind for DPU growth in 2026. Slide 7 and 8 on that air on risk management. Oh, I'll be quick. Slide 7 shows the debt maturity profile. It's well staggered. No more than 24% of their debt matures in any single year. This means no refinancing cliff. This is just good, boring, prudent financial management. It also shows their debt currency profile. 68% in USD, 9% in JPY, 13% SGD. This isn't a risk. It's a hedge. They borrow in US dollars to buy US assets. They borrow in yen to buy Japan assets. This creates a natural hedge, which is smart. Slide 8 confirms this. About 86% of the amount available for distribution in the next 12 months is hedged or derived in Singapore dollars. What this means for you, the Singapore investor, is that your quarterly distribution, your dividend, is protected. It's not going to swing wildly just because the USD-SGD exchange rate has a volatile month. This provides crucial income stability. Okay, let's get to the portfolio itself. Slide 9, portfolio update. This is what you actually own when you buy a unit of MIT. You own 136 properties with $8.5 billion in assets under management. But look at the pie charts. This is the new MIT. By property type, 58.3% of the entire portfolio is now data centers. By geography, North America is 47.2%. Singapore is 45.2%, and Japan is a new growing 7.6%. This is no longer a simple Singapore industrial REIT. It is a global data center REIT with a large, stable Singapore industrial base. This is the growth story. This is why it trades at a premium. But this slide also shows the problem. Look at occupancy rates. Overall portfolio occupancy is 91.3%, which is decent. Singapore occupancy is rock solid at 92.6%, but North America, it dipped from 88% last quarter to 87.8%. This is the headwind we saw in the NPI numbers. Management confirmed that about 1.2% of expiring North American leases are confirmed non-renewals. This is the key operational challenge for the manager right now. They have to fix this. On the bright side, the new Japan portfolio is 100% occupied. Slides 10 through 10 to 18 are the portfolio deep dive. So I'm going to summarize the key takeaways for you. Slide 10 and Slide 18 work together. They show the strategy in action. Slide 10 shows the 14-year track record of growth, acquisitions, divestments, development. Slide 18 shows the result of that strategy. They completed the Singapore divestment of $535 million. And look at the gain. They sold these assets for 22.1% above their original investment cost. This is the capital recycling engine. They sell mature assets at a big profit, and then, as Slide 10 shows, they redeploy that capital into higher growth opportunities, like the new Osaka data center. This is active management at its best. Slide 11 shows the lease expiry profile. This is another reason you own a REIT like MIT. The weighted average lease to expiry, or WALE, is 4.6 years. That's solid, but look deeper. The Singapore WALE is 2.8 years, which is typical. North America is 6.2 years. And the Japan portfolio, 14.2 years. That is an exceptional WALE, providing incredible income visibility. Overall, 36.2% of the entire portfolio's income expires in FY30, 31, or beyond. This is long-term, stable income. Slide 12 directly addresses the North American problem. Management has a three-pronged strategy: reletting, repositioning, and rebalancing. They are actively engaging tenants, backfilling space, and even planning to redevelop older data centers to meet modern AI and hyperscale demand. The key question for investors is, can they execute? Slides 13 and 14 are about diversification. Slide 13 shows you have no tenant concentration risk. There are over 2,000 tenants. The largest one is just 6.6% of income. This is fantastic. Slide 14 shows diversification by trade sector. A good mix of Infocom, 31%, manufacturing, 28%, and others. This means the REIT isn't exposed to a downturn in any one single industry. Slide 16 gives us a final data point on Singapore. Rental reversions were positive 6.2% on average. This means when leases expired, they were renewed at 6.2% higher rents. But it's a mixed bag. General industrial was up a strong 8%. But high-tech buildings and business space was negative 1.6%. This shows the softness in the business park market, likely from tech sector slowing. Okay, we've gone through all the data. Let's get to the final slides. The so what? Slide 19, the outlook. Management lays out the global picture. Global GDP growth is slowing. In Singapore, growth is moderate, and rental reversions will likely stay positive but continue to moderate. In North America, the data center market is a story of extremes. Demand from AI and cloud is insanely strong, but supply is also rising to meet it. This is the battleground. And in Japan, this is the hidden growth engine. Tokyo's market is tight with severe power constraints. MIT's new Osaka data center is in a prime position to capture demand, as Osaka has shorter power delivery timelines. This 7.6% of the portfolio is the high growth story. So, that brings us to the final assessment. My assessment, Mapletree Industrial Trust is navigating a challenging but very manageable transition. The 2Q results show the impact of their strategic divestments, the North American headwinds, and Forex. But underneath that scary 5.6% DPU drop, the fundamentals are holding up much better than they appear. Let's summarize. What's working? The balance sheet is a fortress. Leverage is down to 37.3%, giving them massive firepower. Borrowing costs fell 20%, cushioning the DPU. The Singapore portfolio remains stable, with 92.6% occupancy and positive reversions. The Japan portfolio is a fantastic new growth engine, 100% occupied with a 14-year WALE. And the long-term data center growth story is absolutely intact. What's not working? The North American occupancy, which slipped to 87.8%. This is the number one operational challenge. The normalized DPU is still down 2.2%, reflecting these operational headwinds. And we have a clear future headwind, the rising cost of hedge replacements, which will pressure borrowing costs in the coming year. So what's the recommendation? At its current price of around $2.22, MIT trades at 1.31x book value and offers a forward yield of about 5.9%. This yield is attractive compared to government bonds, but it's not the highest in the S-REIT sector. That 1.3x book premium means the market is pricing in the data center growth. My recommendation is a hold. For existing unit holders, do not panic sell based on the 5.6% DPU drop. That was a misleading headline. The 5.9% yield is a decent income stream. The balance sheet is strong, and management is actively managing its portfolio. You are being paid to wait for them to fix the North American occupancy. For new buyers, those of you looking to deploy your CPF or SRS funds, I would wait. The 5.9% yield is fair, but it's not a compelling bargain given the near-term headwinds. The risk-reward isn't quite there. I would wait for a better entry point. If the price were to pull back to the $200 to $2.05 range, your entry yield would be closer to 6.5%. At that level, it becomes a much more compelling buy. So the bottom line, MIT is a quality industrial and data center REIT, but it's priced for its potential. The normalized DPU decline is manageable, but the North American and interest cost headwinds limit the near-term upside. Hold it for income, but don't chase the price. Wait for stabilization or a pullback to add new money. That's my breakdown of Mapletree Industrial Trust's Q2 results. This is exactly the kind of in-depth, no-noise analysis I provide every single week on the Investing Iguana Substack. If you found this valuable, consider becoming a free or paid subscriber. Your support is what keeps this research independent and laser-focused on what matters to us as Singaporean investors. Thank you for your time, and I'll see you in the next analysis.